Hello, and welcome to another episode of the FinTech Takes podcast. This week, we have another edition of Not Fintech Investment Advice with the great Simon Taylor. As is our tradition, Simon and I each bring a couple of companies to the table that we want to talk about. This week's episode is a little bit more of a classic Not Fintech Investment Advice. Simon brings some very sort of cutting-edge stablecoin AI type companies to the table. I bring some more what you might call classic fintech companies to the table. And as always, we learn a lot by just talking it out. We talk about billing and DevOps in the era of large language models. We talk about mortgage as an employee benefit. We talk about stablecoin yield as an inevitable after effect of the Genius Act and the sort of inevitability of stablecoins competing more directly with bank accounts. And finally, we talk a little bit about open banking for the liability side of consumers' balance sheets. All of that plus manifesting a little bit of fintech magic that we want to see in the ecosystem at the end of the episode, as we always do. This was a great conversation, as always. I'm grateful to Simon for coming on. So without further ado, here is Not Fintech Investment Advice with Simon Taylor. Okay, Simon Taylor is back. Mr. Taylor, how are you?
I'm really well. I'm so glad to be back on this show, Alex. It's our excuse to hang out, and that makes me happy.
It is. No, I mean, it's funny you say that because we were basically doing the thing that you always know a podcast is going to go well when you hop on with somebody, particularly someone you know pretty well, like you and I know each other, and you start doing the podcast before you hit record, and you're like, wait, this is really good stuff. We need to stop because there's good stuff here. So I could tell it was going to be a good podcast even before we hit record. Hopefully, Simon, I'm getting you in a slightly more relaxed summer mode. I know you folks in the UK tend to sort of like unplug at some point. That hasn't happened yet, right? You're still in kind of work mode. Where are you right now?
Yeah, I'm still in work mode, but I'm taking 2 weeks off of brain food.
Good man.
You know about content creation. That's the biggest thing in any week. Like once you get into this thing, it gets you. But I'm taking 2 weeks off. 1 week to do I have a day job and I really want to crank on that. There's some big stuff we're shipping over at Sardine. And then then the week after that, I'm trying to take an actual vacation. Trying to actually stop because I've not been successful at that in the past. And I think I need to, I'm going to give it a shot. How about you, man? How you feeling?
Similar. Content stuff doesn't stop. It is nice at least that there's less travel in the summer. I will say I appreciate that, they give us a break from the conferences. I've been mapping out my schedule for this fall, and it's going to be a madhouse. And so I'm really trying to bank some extra sleep and relaxation, even while the content engine keeps moving forward. Because I know this fall, I think you and I are going to see each other at a number of places, including obviously in Miami in November. So I'm excited for all of the events coming up, but I'm also not sad to be not traveling for a couple of months. And I say all of this, I actually am going to DC in a couple of weeks, but that's my only trip. That's my only one. And then I'm not going to do any more for a little bit. So I'm excited to calm down a bit on the travel.
You're enjoying the Montana summer.
I am. Although it's getting hot. I mean, I'm not going to complain because I think pretty much everyone else listening is probably in a worse position in terms of summer heat and suffering from that. I'm not looking forward to going to DC from that front, I can tell you. But getting a little bit warmer. This is slather kids with sunscreen first thing in the morning before they get out of sight kind of time.
Oh yeah.
If you get away from me, you might get sunburned before I see you again because you're just going to be outside the whole morning. So come here and I'm going to slather you with sunscreen. So we've entered that mode, which is a good time of year.
Yeah, I like it. I'm here for it, man. Should we talk some fintech companies?
Let us talk some fintech companies. As always, we're going to bounce back and forth. I think Simon and I are going to each try to represent our own sort of unique take on fintech companies. Sometimes I try to grab a Simon company. Sometimes you try to grab an Alex company. But I think in this case, we're going to sort of play our traditional roles. You have 2 Simon companies. I have 2 Alex companies. We're not giving fintech investment advice, as the name of this show suggests, but we are going to break them down. Simon, I will let you go first. What's your first Simon company?
The first Simon company is a company called Polar, I think about the polar ice caps or whatever.
Okay. Okay.
So I describe this as being like Stripe billing for LLMs or modern software as a service. So they provide checkouts and complex billing, like subscriptions, customer management, and a global merchant of record capability, all built in one place. But you think, well, isn't that Stripe billing? Doesn't Stripe billing do that? Well, I think what makes this really interesting is they will measure token consumption for an LLM agent or give precise measurements of execution time running on platform if you're a cloud native platform or anything. And they handle a lot of that messy measurement stuff, which becomes like a massive time saver for your billing engine. And then they've also got like this entitlements engine. So if somebody buys access to license keys, then they automatically get access to the GitHub repo or Discord roles. So the idea is you can do this really complex billing for your LLM app. It might be the number of tokens you've used or whatever it is, but I can also get you up and running inside of 60 seconds. So that's kind of the pitch. And it was one of those where I thought, yeah, okay, that needs to exist. I totally buy this. I have zero objections to this being successful. Like it just seems like the whole payment space got solved for e-commerce by Stripe and Adyen and platforms and embedded finance. But it's not solved for agents, and it's certainly not solved for all of this measurement stuff you have to do before the billing. And wherever you go deeper into the problem space, further into the customer's life, that's where you find the pain. And I feel like a lot of the pain now is described as DevOps and analytics, but really is work that could be taken off of your shoulders and then turned into billing. So your thoughts, sir?
Well, that's super interesting. I totally agree on the fact that this is something that just should exist and makes like natural, intuitive sense. I guess first reaction is it's funny how fast the world changes, right? Because and you and I have talked about this before with Stripe. Like I still think of Stripe, and I think justifiably so, based on a lot of the things they've been doing, is like living on the bleeding edge, being staying attached to like the newest parts of the internet economy, like very much trying to in no way become a dinosaur, become like an incumbent. And yet at the same time, there's just always like an edge that's a little further out than you can get if you're a company with thousands of people and thousands of existing incumbent customers, right? And suddenly like the world will change and you'll be like, oh crap, our billing engine isn't really tuned to solve this problem. And then, of course, all of the incumbents are going to work on ways to adjust to take advantage of that. But it's not natively going to be the way they think about building their product because their product already exists and they have to adapt it to this world. Whereas you can come in if you're new to this space and go, hey, anyone who's building a company today, one of the core pieces of infrastructure they're going to use is an LLM, right? They're going to use large language models as like a core component of building a company. It's going to be one of the first expenses they're going to have. What is the right infrastructure to enable the companies that want to sell to those startups, those new companies, to allow them to bill for it, to allow them to manage that? So I think that makes a lot of sense and is just another example of this, like even Stripe is going to get sort of unbundled or attacked based on some of these kind of cutting edge changes that are happening to the internet economy. The other thing it makes me think of, Simon, and I'd be curious for your take on this, is you mentioned DevOps. My observation of the last, 20 years is that the sort of DevOps industry kind of evolved a little too late after companies' cloud spend sort of went out of control, right? And so the model in sort of public cloud in the early days was, Amazon or Google or Microsoft or whomever, basically going to companies and say, hey, just sign up for this, use this, it's going to go great. You don't have to really think about it. And then it took, and I was there during this window of time, it took quite a while for those companies to realize, oh my God, like we're having our eyeballs ripped out of their sockets in terms of cost that we're paying for this. We should probably have like more granular, fine-tuned infrastructure for monitoring our spend, for measuring our spend, for managing our spend on cloud computing than we'd had before. And it almost felt like the emergence of the DevOps space was sort of an allergic reaction to like cloud computing providers sort of extracting too much value out of their customers in the early days. And I guess the thing I'm curious about is, it seems like this solution is coming along quite a bit earlier in the evolution of large language models and stuff than DevOps came with the evolution of cloud computing. I wonder if companies are going to be better equipped this time around to manage and monitor and sort of finally control their expenses around LLMs and generative AI much better than they were, and much earlier in that process than they were with cloud computing. Does that resonate at all with you?
It massively resonates. I guess on the first point, on Striper, through their difficult teenage phase, they've gone and got a job. They're a profitable company now, but now there's all of these other people having difficult teenage phases and being all growth spurts and whatnot. So it's like it's like an interesting change of dynamic. You wake up one day and you're 40. It happens.
And there's nothing you can do. You can try to be like the cool 40-year-old who still listens to like cool music, but you're 40. There's nothing to do about it.
No, I'm still using Shazam to figure out what that beat was. But there's a stat. So I had the privilege of interviewing Will Gabrick for the Tokenized podcast just this morning as we record this, and they I think they've used this stat before, which is like 78% of the AI 50 by Fortune or whatever it is use Stripe. But Will dropped a nuance, which is, and all of the ones that do any form of customer billing use Stripe. So that's ChatGPT, it's Anthropic, it's 11 Labs, it's all of those companies, and so they still do a pretty good job of being indexed towards growth. I think they stay paranoid in a really fascinating way. But then there's like Move and Rainforest and all of these companies that are almost a reaction to Stripe doesn't quite do that thing, so we're a better payments company that does that thing that you kind of graduate onto.
We'll be better for this one specific thing, and maybe not like a million times better. It's not like Stripe is terrible at that thing. They're just not optimized for that thing, right?
And I wonder if they're going to M&A their way into that. Like, is this an M&A target? Are they going to inevitably build it? But sort of your DevOps spend metaphor made me think of a conversation I had with the guy who ran payments for, I think it was Instacart or DoorDash. I can't remember which one it was. And they said they became one of Stripe's biggest clients. They were using them a massive amount. They were absolutely reliant on them. And they must have got to 8-9 years in before they even started to think about going multi-PSP and their unit economics. They didn't realize how much money they were leaving on the table by not focusing on that area. So, I guess what I'm working back to is what I like about Polar is they've diagnosed a problem that's not just cost, it's billing. It's like it is really hard for me to bill for each AI token used. It's really hard for me to bill for usage on the cloud platform in terms of minutes and metering. You've solved that problem for me, and you just happen to do billing, and you might process the payment with somebody else, but you solved the immediate problem rather than solving the one I'll realize in 7 or 8 years' time once I'm big enough and I go multi-PSP. Because most of Stripe's absolutely mega clients eventually go multi-PSP, and they sort of go that way. And even Shopify and all of the case studies, they're multi-PSP. They still use Stripe as the default partner, but they go multi-PSP. It's just what you do. So I wonder if that's where how this kind of shakes out, and if the wedge is solve a different problem, not the payments problem.
Yeah, no, I think that's right. I mean, payments is always like the thing that gets attached to it to make it actionable, but it's not always necessarily the problem. It's attached to the problem. And I think you're right. I mean, the other thing I wonder about with this is, LLMs and this sort of new wave of AI via API, it is different, I think, than public cloud computing, in the sense that I think with cloud computing, they were really able to present a huge cost savings in terms of upfront investment, because the alternative was really well known, which is you have to build your own data center, right? And building your own data center is huge CapEx. you have to spend, the first transaction costs you $20 million type of thing, right? Like it's really expensive. Whereas cloud computing providers could come in and say, well, we're going to save you all of that. So like, don't worry about the billing and the costs and like whatever, like don't worry about DevOps, like look how much money you're saving. And you were saving a bunch of CapEx, but you were also indexing your OpEx to include this cost that would scale with you infinitely, which is why AWS became sort of the most profitable division of a company in the history of capitalism. I think with AI and with LLMs, it's a very different thing. Even though it's new infrastructure, it's kind of similar in that way. LLMs are coming in and saying, hey, here's this new capability. We're not compared to anything, right? Like you can't compare cost on LLMs to anything you're currently spending. And so it is by its nature going to seem new and expensive. And obviously, like LLMs are expensive to integrate, right? They cost a lot of money, even though inference and scaling laws are helping in terms of bringing that cost down. They are expensive. And so I wonder if the market dynamic is more, hey, this thing is expensive. Therefore, if you're selling this thing, you really should bundle it with a really good billing engine that allows your customers to price this out and to use your service in a really granular way that makes sense for them. So I wonder if the incentive around LLMs, even though I'm using this cloud computing DevOps analogy, I wonder if the incentive is very different this time around in terms of cost savings and more granular approaches to billing need to be a front and center value proposition offered by the providers rather than something that the market realizes it needs 5 years from now.
Yeah, it do it now, and actually
right.
By making it front and center, you unlock the market's growth and you unlock its next phase. Although the flip side of that is these things are growing at such an unbelievable rate that are they even going to notice? I mean, what's Cursor doing? 300 million of ARR, one of the fastest growing. Nearly every AI company, nearly every single one of them is one of the fastest growing companies in history. We are living through something quite ludicrous. I think there's simultaneously a massive AI bubble and silliness going on and a massive story of revenue growth, the likes of which most investors I speak to have never seen before. It's like, so it's very hard to pattern match what's going to happen because I don't know how much the patterns really apply. Having a conversation earlier today, which is sort of saying a lot of the things that an AI agent can do if it lands in agentic commerce is deal with little bits of friction. So the agent itself can handle more of the conversion problems that we would have had. And it's willing to answer more questions to reduce its own fraud risk. And if it looks like a bot, it's going to say, hey, I look like a bot, but I'm also a good bot. Here's my evidence. And do you want to challenge me some more? So like having things like that, the thought experiments that you can start to do with this space, like what would an agent want? What would an agent be capable of? Sort of changes the model. But ultimately, all of this rests on silicon. All of this rests on a hyperscaler. And that's about the only thing I can ground myself in at this point.
No, I agree. And I think you're right about, a lot of this is tough to kind of to grok. Pun intended there, that it's just difficult to figure out like, well, how much are these AI hyperscalers really even trying to make revenue? Like they're making revenue hand over fist, but it's almost sort of a secondary thing relative to trying to grow, trying to grab market share. I've been looking at the comp packages that are reportedly being offered by Meta to poach OpenAI employees. And like the numbers are stupid. Like they don't even make any sense. And so I do think we're in that point where it's a little difficult to even understand what these numbers mean and what the sort of value propositions are that are going to make sense once this market becomes a little bit more rational, which it certainly isn't at the moment. But this is an interesting one. Simon, can I give you my first company?
I feel like we need to swing the pendulum to something more Alexy, so let's go.
Well, could not be more Alexy. This is so not generative AI. This is a company called Multiply Mortgage. And this is a mortgage as a benefit. So basically the idea is Multiply sells through HR departments, sells through companies. So an employer signs up and the employer is able to offer a discounted mortgage plus a human loan advisor to their employees at zero cost to the company, right? So the idea is essentially that Multiply Mortgage is this non-bank mortgage originator that has built a sort of digital AI native tech stack for very efficiently processing mortgages. And that efficiency combined with their distribution through employers, meaning that they don't have to pay customer acquisition costs to go get customers, means that they have a larger margin in mortgage lending than most have. And they use part of that margin to essentially offer a discounted mortgage rate through employers without having to charge the company, or without the company having to buy down that rate. And it's fascinating to me. These guys recently raised a Series A in March of this year, launched in 2022. They're live in 45 states and the District of Columbia. And it's fascinating to me because I've had this theory for a long time, and it kind of speaks to the sort of fall of the American empire in a way. Like, it's kind of depressing to think about it in sort of a larger context, but housing affordability is like the number one issue, right, that we struggle with. And I know this is true in other countries outside the US as well. Like, housing affordability is just like the issue of the time right now. And I think the problem is that fundamentally, people just can't afford to live where they want to live, or can't afford to live where they want to work. And so if you play that sort of trend out over a longer period of time, and you think about, well, what are the areas over time where employers have gotten more involved in finance or financial services, and what has driven them to do that? It's always driven by a recognition that, hey, this thing, and you can use retirement savings, 401ks, any number of different examples. This thing, earned wage access more recently, this thing is something we have to offer to our employees in order to recruit and retain these employees. And I think housing is going to become one of those things, right? Like, if you're a company and you're trying to get employees to live in a specific place to work in that place, right? So it's probably less relevant to remote work, but it's certainly very relevant to, hey, we need you to be in San Francisco, or hey, we need you to be in Austin, or wherever. You have to factor into that. Can your employees, at the salary that you're paying them, afford to live in that place? And if they can't, or if they need help doing that, that might incentivize companies to view mortgage or discounted mortgages or available mortgages as a benefit through the company, as something that they might want to get involved in. In particular, in the case of Multiply, if they can make that pitch available to employers without it being any cost to the employers. So from that perspective, there's not a ton of downside to the employers. And there is potential upside in being able to integrate this as an employee benefit and hopefully retain and attract talent where you want them to live. So, Simon, what do you think about this mortgage as a benefit concept?
Immediately heard it and thought, oh my God, embedded mortgages are finally here. Embedded finance may have peaked. I did a piece a long time ago called "Fintech is 1% Finished," and in that I sort of recounted like all of the customer segments and then all of the products within all of the customer segments. And what we do is we've gradually been coming up the complexity curve from the simplest products, accepting payments, making a payment, basic deposit accounts, yielding accounts, bit of lending at the point of sale, lending that's embedded, lending inside of a platform, credit cards and high net worth accounts and brokerage. Mortgage is like one of, if not the most complex consumer product imaginable. Like, it's just, there are so many little details state by state, and just such a big purchase, so much other parts of the workflow. But it's also the one that's the biggest monthly expense, maybe right up there with childcare, but definitely one of the biggest monthly expenses.
Yep.
And that is set against the background of an affordability crisis. And that affordability crisis is not seen in the headline GDP figures, so it's being masked. And it's not seen kind of in the mainstream news, but it's quietly under the surface why every incumbent government's getting knocked out around the world is like inflation's ruined the kind of the social contract.
Totally.
So what do you do about that if you need to retain people? Well, we've seen this play out in the gig economy, which is I will wrap around you a bunch of things that keeps you as a consistent, well retained employee and or worker because I'm going to do that. It sort of reminds me actually a little bit of in Detroit, a lot of the auto workers, they actually built housing around those factories. In the UK as well, around the original chocolate factories and around the Industrial Revolution. A lot of housing in the UK was built around the Industrial Revolution for workers in those factories.
It's not like historically unusual for companies to provide housing, right, to their employees, right? Like we've seen various versions of that. This is just kind of a modernized version of that same idea.
And so working back to all of that, I think this makes absolute sense. I just start immediately wondering who's the employer that goes for this and what does the distribution actually look like practically? So if I multiply mortgages, am I going into like what's the benefit system I need to get into? How does distribution work? Educate me on that stuff.
No, it's a really good question. I mean, I think there is a level of like system integration, right? Which is to say companies have HR and employment systems that they use to like basically manage their employees that the employees have direct access to, right? This includes obviously payroll, but there's like a larger universe of employer systems. So you want to be integrated into those systems. I think the other kind of question tied up in that, Simon, is, well, which sectors does this make the most sense to kind of go after? Like, where do you start? And one of the things when I was poking around a little bit that jumped out, and this shouldn't be a shock on a number of levels, is the sort of tech startup space, right? Because in a lot of cases, even though technically a lot of the work can be done remotely, a lot of these early stage companies want to have their employees in San Francisco or in New York or wherever the office is. And then the other component of this that I hadn't really thought of, but I think is pretty interesting is you see this happen a lot. A lot of companies have compensation structures that make it difficult for their employees to get mortgages, right? So the classic sort of Silicon Valley example of this is the equity you have in a private company as an employee in an early stage startup. That's hard for lenders to evaluate as income, as an asset. It's difficult for them to take into a calculation. I think theoretically, what Multiply could do if it was more deeply integrated with these specific companies would be to give those companies a little bit of flexibility in terms of helping their employees count their equity or their stock options in as assets, and Multiply being sort of the, in some ways, interface between the lender and the bank and the funding mechanisms on the back end, because they're not obviously holding the loans on their books, and the employers who say, look, this is an employee who has this income, they have these assets, and one of those assets is shares in our company, and here's how you should value those. Now, obviously, there's lots of like risks and challenges there, but I think that kind of points to where are some of the pockets where Multiply could get early traction, right? It's a combination of we want our employees to be in a specific geographic location. That geographic location is expensive for people to live in, and having an affordable mortgage is a way to make housing more accessible, and perhaps the way in which that employees' assets and income are measured is a little non-traditional, but Multiply can help sort of standardize that a little bit. So I think it's some combination there is sort of where you start, but I could also see potentially this being, I don't know. I mean, couldn't this be like an acquisition target for Chime maybe down the road, right? Chime's gotten into like their employer-focused solution. It's called Chime Enterprise. Like they're trying to sell financial stability as an employee benefit to large employers. You know, Chime has no interest in being a bank or being the lender of record, but couldn't they be the non-bank originator for mortgages for employees who are working at, a fast food restaurant who need to live in that place but can't afford to live in that place. Like this, if you pull on this string, it does make sense. It's just potentially the distribution by itself might be a challenge unless you get acquired. I think that's where I'm sort of hung up.
Yeah, and I wonder who the segment is, and maybe Multiply is still trying to figure that out, because you spoke to two there, which is like the tech employee who is option value is potentially really high, but they've got to buy those options, and it's hard to value them without a cashless exercise. And then you got to think about taxes, and then it can be taken into consideration for a mortgage. So nobody does that well. And if you're part of the employer hierarchy, you can solve some of that. And I really care about in person, so let's fix that. That's one go to market. And maybe the answer is both. The other go to market of, you've heard of Chime, your mortgage is with Chime. I think that's got some brand cachet, especially with the sub $100,000 income segment and bracket, which is where like home ownership is sounds like I might as well go to the casino. Like this is just not going to happen. So how am I going to get there? But actually through my employer, I can build my way to it, and I've got this discount. I just wonder how possible any of this is with 7% rates, and no sign of them coming down.
And that's the question, right? And so I think the other part of this model that is interesting is it is very much dependent on the economy on a number of different levels, right? If the interest rate environment changes, I actually think if interest rates go down, that could potentially be challenging for Multiply, right? Because I think part of their value proposition is we are efficient in how we do this. We pass some of that efficiency in the form of cost savings on. We make mortgages more accessible in a high rate environment to employees through their employers. If rates come down, that margin gets compressed, and suddenly your cost advantage is a little bit lower. And so I think changes in the macro environment are potentially a challenge for them. And then I also think the other challenge for them is just the broader economic situation. And obviously, I've given up trying to predict recession, economic sort of pullback, tariffs, like who the hell knows? I have no idea what's going on. But you could envision a world in which competition for employees is less because unemployment is higher. And if that is the case, if that's the environment we wind up in, suddenly offering any type of employee benefits beyond the standard things, there's much less incentive to do that because you have unemployed folks fighting for the jobs you have open rather than you trying to fight to retain employees who have lots of different options. And so I do think that broader, there's a lot of cyclicality built into this idea. And obviously anything that touches mortgage is sort of inherently cyclical, which is kind of why, again, I think this might end up being more of a feature of a larger company that can sort of withstand that sort of cyclicality. But again, we'll see how this evolves.
Yeah, I feel you. This is going to be fascinating. May I hit you with another Simon sounding company, because that was surprisingly, like I think that was a little bit in between us. I really enjoyed that one.
Well, good. I'm glad it did. I enjoyed yours, for the record, your first one. But why don't you give us the second one and see if we can go 2 for 2 here?
Okay, this one's called OpenTrade, and they are embedded yield as a service for anybody who's got stablecoins. So if you're a fintech company and you want to offer yield to your company customers, but you can't because stablecoins can't offer yield, OpenTrade handles a lot of off-chain banking and asset custody and manages bankruptcy remote SPVs to ensure asset safety on money market funds. They also handle all of the on-chain connectivity to the Ethereum ecosystem. So if I'm a fintech company like, say, Nubank or Revolut or Chime or whoever, and I want to offer my consumers stablecoins, and as is becoming the case, Takeda is now the fastest growing, most downloaded app, I think, in Mexico. Cast, K-A-S-T, is one of the fastest growing fintech apps in the world. They just happen to use stablecoins. They can now offer yield. So stablecoin becomes my checking account, and then brand can offer embedded yield as a service through OpenTrade. So, yeah, I mean, look, if every company becomes a stablecoin company, OpenTrade is how they add yield. I think about, I mean, Alex, you and I are veterans of this now, the amount of treasury management companies that offer money market funds. So I'm thinking about your Mercuries, your Ramps, your Meows, the list goes on. Now consider all of the markets that Ramp has just announced they're going into with stablecoin financial accounts. Wouldn't you want to be able to switch between stablecoins and tokenized money market funds 24/7 in 101, 102 markets or whatever it is? So I like this one. It feels like a no-brainer. Really interesting story behind this company. OpenTrade, actually, as the name suggests, started out in trade finance in like 2016, 2015. And they've been grinding it out in that space for a little while. And then suddenly this like one thing they did to help trade finance with stablecoins just really took off when all of the fintech companies that were offering stablecoins that didn't share their yield were starting to come along. So what say you, Alex Johnson? Does this fix the yield problem, or does it just make narrow banking more likely?
That's so funny. It probably does both in a lot of ways. I mean, so a couple things on this. I have been of the opinion for a while now that while I understand the purpose and the intent behind banning stablecoins issued in the U.S. From offering yield, that practically speaking, this is just going to be impossible to stop, right? I've thought about this a lot, right? And then, I mean, the poster child for this is Coinbase, which doesn't actually issue its own stablecoin, but has an arrangement with Circle such that it can incentivize its customers to hold USDC in their Coinbase wallets, in their Coinbase accounts, and be paid interest functionally on that. And the arrangement is super beneficial to Coinbase, which actually makes a ton of money on USDC given its arrangement with Circle. But technically speaking, they are not the issuer of USDC, and so they are allowed to offer yield on top of USDC. So I just think that, and you have all of these sort of non-bank, non-finance companies that are looking at getting into stable coins. They'll have other ways to incentivize adoption of stable coins. I know there's some like non-evasion language in the Genius Act, but this is a really hard one to stop. And the incentive on the part of the person offering a stablecoin, obviously, is to make the stablecoin as competitive as possible. And to do that, yield is a big part of it. I guess, Simon, the question I have for you, and forgive me for just being an idiot on stablecoin topics, but that's kind of my brand. So I'll just lean on you here as the expert.
It's really not, but go ahead.
I appreciate that. I try to ask questions. My question on this one is the idea functionally that like I can get a stable coin from this fintech company, and then I can essentially, I'm just going to put these in air quotes because I'm using banking terms, even though this isn't really banking specifically, but I can sort of deposit my stable coins into a yield bearing account where OpenTrade goes out and does something else with the money that I give them, and in exchange they're generating some yield and passing that back to me. Like mechanically, can you talk me through how it works between OpenTrade, the fintech company that they're working with, and then their end customers?
So they're all sort of like, think of them as little towers. And at the bottom of the stablecoin tower is a Circle-like issuer. And what are they doing? They're buying treasuries, or you could even have a bank that's issued the stablecoin, and it's reserved against deposits. So that's the issuer. Then against that, you'll have the blockchain network, and Solana, Ethereum, whatever else. That's where I have my address, and that's where the asset actually lives. And then above that, I might have some sort of intermediary that's sort of custodying that asset for me on chain, as well as the issuer who's custodying it off chain. And then finally, I might have some hops between me and a UI layer, and that's what my stablecoin looks like. Then on the opposite side, if we work our way up, we've got this special purpose vehicle or a tokenized money market fund. That then is represented on-chain by a token on Ethereum or Solana. And then moving up the stack further, I've got some intermediary and I might have the UI layer. Now, the way that works at the UI layer is I can instruct what we call a swap, where I will sell one token and get another token. And that's just a very simple smart contract. And those swap operations happen on chain as soon as it settles on the network. So from the UI to the intermediaries to on chain, that token switches instantly 24/7. What you end up underneath that is the real assets, the SPV and the dollars never moved. But what did move is so it's like the FBO and the money market fund, like those were still sitting in the custodian's accounts, but the legal owner changed. And the legal owner sort of sees like a different balance in their sort of sub account or the sub ledger. So FBOs plus subledgering is a good way to think about it, but FBO plus subledgering for money market funds. So to me, the consumer, I did a swap operation and I took my dollars and I deposited them into an account. But the reality is, no, I didn't deposit them into account. I swapped them. But I can swap them back instantly, and I can swap them as much as I want. I'm essentially using the blockchain or blockchains as a sub account for the FBO.
Got it. So from the end customer's perspective, they can sort of think about it in similar terms as, as we do with bank accounts, checking accounts, savings accounts, money markets, where it's like, here's the pot of money I have where I'm sort of like keeping funds. They're very stable, very accessible. I'm making payments. I'm doing whatever. Here's the slightly less accessible, but slightly more yield-bearing pot of money that I can move stuff into or take money out of. And here's maybe the even less accessible, but even more yield-bearing thing that I can move things over. So there's like different groups. I guess a question I have for you is, and it's so interesting, right? Because the prohibition on the stablecoin issuer offering yield is just like an artificial constraint that's placed on the stablecoin issuer, right? There is a return that they could give to the customer. Like there is a margin there that they could pass on to a customer. So is the idea with OpenTrade that they're essentially allowing you to swap with similarly safe assets at the bottom, but we're going to pass along yield? Or alternatively, and it could be both, honestly, is it we're going to have a slightly different mix because we're not a regulated stablecoin issuer. We're going to have a slightly different mix of assets at the bottom of our little tower where it's going to generate even more money for us than a stablecoin issuer would be allowed to make. It's the first thing. Okay, that was my question. There's not more risk there.
OpenTrade is like banking as a service for a money market fund at Vanguard or whatever brokerage.
Got
right?
it. So I should be thinking about this in the context of bank deposit account, government money market fund, similarly safe, but the yield profile is different for reasons that are more related to how they're regulated.
Stupid reasons. Okay. And frankly, this is why I think the bank lobby pushing back against stablecoin yield is just stupid.
It's not going to work. Like that's what I keep kind of bumping up against is like you can try to stop it, but this is a wonderful illustration of crypto will just find a way. Like it'll just find a way. It'll just find everything is. It is right, and it's like and this is a really great example of this because. Again, as you very well illustrated, the common layer at the middle is that protocol layer, right? It's the blockchains that these things sit on. That's what makes them
That's the whole point.
Inherently interoperable. Right. So it's like whatever thing you're trying to stop from happening, if someone else connected to this global network builds a thing that this thing can swap with, we functionally built a go around it. There's no way to stop this from happening.
So here's a couple of examples that take that further. Yeah. Robinhood just announced tokenized stocks right now. And what they've actually built is closed loop. What they've actually built is kind of like the early days of Cash App or Robinhood doing crypto. It's like you can have crypto, but only inside of our little walled garden. And so every hater on the world is going, that's closed loop. And the economics are worse than existing kind of funds. Like the spreads are terrible on buying assets. play that out. The same was true with stablecoins. The same was true with crypto. Robinhood eventually went open loop. So have many others. And so once that happens, now you've got access to my checking. I've got access to deposits with yield. I've got access to brokerage, and they're all swappable instantly and 24/7. And then somebody goes, okay, yeah, I can swap all of those, but they're all tokens, and they all reference something that's real, that's off chain. And that's changing. I just happen to have the fortune of being one of those people that was the misfortune of being one of those people that was trying to do distributed ledger technology in 2015, 2016. I was head of crypto right. R&D for Barclays. Like, that idea was fundamentally still correct. And when people talk about real world assets, really they're talking about wrappers on real world assets. Now, let's not forget, wrappers can be useful. ETFs are just wrappers on real world assets. So wrappers can be useful. Don't underestimate wrappers. Nas and Biggie did pretty well after all. But the real thing that's coming is we're starting to see stocks and assets issued directly on chain. Yeah. There's a Brazilian bank that is going directly on chain with fiat currency money printing. When books and records, when the underlying asset is on chain native.
Yeah.
There's some trials that the UK has done and Europe has done about issuing sovereign debt directly on chain. If sovereign debt goes on chain, then I mean, look, it's all trials, it's all early, but these things where I think a lot of the objections people have are like kind of like saying the internet's slow for video in 97, 98. Yes, you are correct now, but you're also missing what's coming. And I think you have to focus a little bit more on like that stuff.
No, I totally agree. And I think just to add one final thought on this one, the thing that's interesting is, and again, it kind of ties back to the prohibitions on yield-bearing stablecoins in the Genius Act. The problem, I think, is we try to regulate this stuff based on sort of an imperfect understanding of how the technology works, right? And it's challenging, I think, from a regulatory perspective. The tokenized stocks is another good example of this, right? Like, to your point, when you start wrapping these real-world assets, these stocks on chain and putting them on chain with wrappers, it has the effect of creating this workaround that can really be sort of a huge arbitrage opportunity for the companies that are doing it and for customers who want to take advantage of it, right? I mean, the thing I've been thinking a lot about is people have been talking about, the benefits of tokenizing stocks is we'll be able to give people access to invest in private company stocks that they can't get access to today. Well, that's great. And I'm not saying that that's necessarily like a bad thing. However, there is also historical reasons why private company stocks are not available to average retail investors. And not that we shouldn't find ways to open up accessibility, but we have to do that within the framework of how do we make sure people know what they're investing in? How do we make sure we're protecting retail investors? And so it is really interesting to watch when these discussions around, like, I think Vlad at Robinhood was on some interview and he was talking like, our goal is to basically tokenize everything. Mm-hmm. The idea of tokenizing everything, it's both inevitable from a technology perspective, but also incredibly disruptive from a market structure and regulatory perspective, because all of the ways that these things are structured today are dependent on a set of assumptions that aren't going to be true if we tokenize everything. So we need like a new structure to manage this stuff.
Well, this is the goal of the Clarity Act, which will be what follows Genius, and it's a little earlier in the pipe, but it's definitely being done with good intent, I think. There's a chap you should speak to for one of your podcast episodes, which, if you haven't already, Dr. Chris Brummer. Chris,
I was on a podcast or a panel with him at StableCon, actually, so I got to know Chris a little bit.
Yeah, so Chris is sorry, I called him Doctor. He's Professor Chris Brummer.
Georgetown, right? Yeah.
Yes, Georgetown University. He's also the founder of Blueprint, which is a disclosures platform for any MiCA compliant company. And he's possibly the world's foremost expert on disclosures, because in the tokenized world, what does disclosure mean? And, like, how many people go read the Edgar database and really understand what they're looking at versus everything else that's happening in and around disclosures? So it's going to be interesting times in the near future, Mr. Johnson.
I am excited about these interesting times. All right, so Simon, I'm going to give you my last company. We'll go quickly on this one. The last one I have for you is another company that just raised Series A, Spinwheel. Are you familiar with Spinwheel?
I've heard this name. Have they been around for a little while?
They have been around for a little while. Yeah, they were a part of this trend, I guess you could say, that popped up not that long ago, really, where we had these companies that were kind of trying to apply the Plaid playbook to other areas, right? So Spinwheel, in like a very broad generic sense, is Plaid for liabilities. So if you think about Plaid as mostly historically focusing on bank transaction data, bank accounts, the asset side of the balance sheet, Spinwheel is one of a few companies that said, all right, well, why don't we try to build similar amounts of coverage, but on the liability side of the balance sheet? And I think that is a pretty interesting concept generally. Where a lot of these companies got their start was this idea of like embedded debt repayment was kind of the concept, right? So like if you were a fintech app like SoFi or someone like that, you could essentially build into your app the ability for a consumer to link their liabilities, their credit cards, their loans, their whatever, and they could link all of that into your app. And then you could create an experience on top of that that was like, hey, let us refinance this loan for you, or let us suggest a strategy for how to pay off these 3 credit cards to minimize the amount of interest that you're going to pay over time. So sort of embedded debt repayment based on a view of a consumer's total liabilities was sort of the initial wedge use case for this. That use case, I don't think was overly successful. I'm not, I guess, terribly surprised by that. Anything in like the PFM debt repayment space is always kind of a tough thing to make money on. But in the course of doing that, in the course of building for that, several of these companies, including Spinwheel, built pretty good coverage on the liability side, right? And they did that by sort of fusing together traditional credit data, so looking at the data that's in the credit file, with more direct consumer permission data that's accessed through loan servicers, that's accessed through core systems, that's accessed through direct integrations with lenders. And so they sort of supplemented and enriched, in some senses, the view that you could get into someone's liabilities through the credit file with all of this direct first-person permission data. And I guess the thing that's interesting, they just raised a Series A. The thing that's interesting to me is, in the same way that open banking and sort of Plaid and those folks have sort of enriched the lending ecosystem by bringing asset data, by bringing bank transaction data into sort of this worldview and making it accessible to lenders, I wonder what consumer permissioning can do to enrich the data on the liability side above and beyond what you might get from a credit bureau, right? So there's a couple different examples of this. There's BNPL, which I've written about recently. The BNPL companies really don't want to furnish their data to the credit bureaus, right? The credit bureaus are having a hell of a time paying for BNPL data integrated into their data set, because the BNPL companies are like, man, we don't want to give this data away. We don't want to furnish it to you. We don't want to be an FCRA compliant furnisher. We don't want to give our competitors a view into our customer base. Like, we have no incentive to share this data with you. Well, all right, that's fine. But if you're a lender, you need to know what BNPL activity a customer has been taking on. You have to know that information. Consumer permissioning is another way to get at that. And what I've noticed is that a lot of the traditional data aggregators on the asset side, they haven't, for a variety of reasons, done as good a job building out like coverage of BNPL, coverage of earned wage access, like all of these sort of novel product types that aren't in the bureaus, but also aren't always covered by a Plaid or a Finicity or an MX. And so I do think there is a window for Spinwheel to kind of get involved in this area and almost be like a super version of a way to access traditional credit data that's more real time and has more coverage and more details than you would get from the credit bureaus, but fundamentally is answering the same question that the credit bureaus have historically answered. And Simon, the last little bit of context on this is, I think that with 1033 and with the open banking rule in the US in peril and potentially just going away and being vacated by the CFPB, this actually freezes the market in a way that might be beneficial for some of these aggregators like Spinwheel, because now it's going to be harder, if that happens, for someone else to come into this space and go, oh yeah, well, now that like open banking is regulated, anyone can kind of build coverage and become an aggregator. Like, that's not going to be true. No. And if that ends up being the way it goes, it'll be hard for other people to catch up to someone like a Spinwheel who spent the last however many years building coverage in the space. So that's kind of what I've noticed on this one. What do you think?
Yeah, thank you for unpacking that, because you've answered all of the questions I would have had, which were essentially, how on earth does this thing have a right to win when surely I can get access to credit data and cash flow data already? And your answer is coverage and everything else. That's the last mile is the hardest. Yeah. And that is in itself incredibly hard to build. They just happen to have built it, and now they're pivoting it for a different use case. Credit to the team. I think I met the founders a little while ago. Great human beings. We should get them at NerdCon.
We should. There's your invite if you're listening to this particular segment of the podcast. Come speak at NerdCon. No, I mean I agree, and it's kind of fascinating how, and we saw this with Plaid and with others too. You build this infrastructure, and then you have to find the right kind of killer use case for it. And sometimes what you think the killer use case is doesn't turn out to actually be the killer use case. Like for Plaid, I don't think they could have predicted that account verification in the early days would be such like a killer use case, but it was, and it kind of drove the whole thing. And what I see with Spinwheel is them kind of pivoting away from where they started, which was cool, but didn't really like set the market on fire, to more of this kind of credit lender focused play that I think might have more legs.
Well, let's hope it does. Is there anything you want to manifest before we check out today?
I would love to manifest something really quickly related actually to what we were just talking about, which is this is less of a private company thing and more of a regulatory thing. I actually think it would be lovely to have a public credit bureau.
Oh, wow.
Because I've been thinking about this a lot, because the BNPL data getting into the credit bureaus thing is frustrating me. And the problem is there's no mechanism to force the BNPL companies to do it. There's just there's no law, there's no legal mechanism, there's no regulatory way to force them to do it. And I kind of realized as I was thinking about this, not that we should replace the private credit bureaus with a public version, but I kind of view it as like the post office, where I kind of think the credit bureaus need a public competitor just to sort of keep them honest, right? And I'd be very interested in what it would look like to stand up a public credit bureau, to let the government run it maybe in a different way than the private companies run it, and just to sort of provide a point of contrast and a point of competition to the private credit bureaus that sometimes by their own choice and sometimes just because of the position they're in, don't have the ability to adapt to some of the things that are happening in the market as much as I would like. So that's my wild and crazy idea, not to turn the end of this podcast into like a New York mayoral race debate or anything, but
but like a Fannie or Freddie, but for credit. Actually doesn't sound as crazy when you frame it right. I guess we should go into sales. I'm going to manifest the same thing I always manifest, which is just like I spent a lot of time talking to people who are close to Tether and Tron lately. I'm going to manifest a version of Tether, which I think we need, which is the payments mechanism for the financially excluded that doesn't have Tron involved. And because Justin Sun and all of that is just... I don't think even if Justin Sun was involved, it's nothing against him personally. It's just the trolling nature of what he's done, and the fact that there just wasn't a focus on crime and anti-money laundering, and the amount of human misery that has been funded through money laundered through the regular banking system, and now potentially things like that. Is something that I just it gives me more than heartburn. It keeps me up at night. It really bothers me, and it's a plague on our society, and we should fix it. So I'm manifesting like just better stablecoins all the way through, and including and especially for the global south.
I could not more heartily agree with that. That is a great thing to manifest. Simon, we're over time. I will let you go. We'll do this again next month. As always, a delight, sir.
I cannot wait. Speak to you soon, sir.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.